Hello and good morning and welcome to another Betashares managed account quarterly update. It's a Friday and it's sunny, so we're pretty happy to be here and presenting for you today. As always, my name is Gavin Montgomery, Director of Advisor Business here at Betashares, and I'm joined by my friend and colleague Cameron Gleeson, Senior Investment Strategist. How you going, Cam?
Good, Gav. Good to be here.
Good. Look, I'll just jump through a couple of quick notes. Firstly, as per usual, here we go. Just having some slide issues here. There we go. As per usual, this is general advice only and is not limited to your situation. In the quarterly update, if you want to ask any questions that you've been thinking about, obviously you can send myself or your account manager an email. But if you'd like to ask questions throughout to have Cameron answer, feel free to use the question box on the side of your drop-down panel. In terms of the advisor services team, many of you may be familiar with myself. We've also got Eliza Yankin covering South Australia, working with myself, Chris Yates in New South Wales, Alex Holmes in New South Wales, James Ralston in New South Wales, and Kat Coe in New South Wales.
There's some nice photos there, Gav. I like those.
Yeah, a lot of people in New South Wales, Cam. Look, so we'll keep things relatively quick today. I'm going to pass over to Cam to touch on a brief economic update. We don't have David Bassanese with us today, but we've got a very good looking investment strategist with us today as well. Don't sit too close to me, Cam. And then we'll touch briefly on our DAA managed account update as well, which will briefly go over some of the changes that we've made on a quarterly basis. And then we'll allow for some questions at the end if there are any pending.
Thank you, Gav. Thanks for that introduction. And good to be with you again here today. So as Gav mentioned, I'll talk about where we're sort of seeing the economic landscape and some implications for markets. Also talk a little bit about our discussions within the IC and how we've arrived at our decisions in terms of model changes. Now, in terms of, looking at the big picture, the story really of the last week has been the Fed's 50 basis point cut. But really, when we're sort of thinking about our backdrop and our baseline for, looking at markets, in some senses, the Fed really does matter more than, really any other economic actor. And what we've seen over a period of the last 4 years is a focus on one part of their particular mandate being inflation. And that's sort of represented in the chart to the right of screen there, the core PCE inflation shown there. And that's coming back nicely down towards target for the Fed, which is 2%. Since July, the Fed has increasingly signaled an elevated level of interest in the second part of the dual mandate being full employment. And that's unemployment rate represented there in the chart left of screen shown there. Now, through the sort of second quarter of this year, we did start to see the unemployment rate tick up by 0.1% 4 consecutive months in a row, and that's obviously sort of driven concerns about whether the economy is going to withstand this huge level of rate hikes that we've seen. But increasingly the importance of the inflation, that high inflation rolling over and coming down consistently has allowed them to sort of pivot towards more of a dovish outlook. And so on Thursday morning our time, we saw the 50 basis point rate cut. And that was something which was very much debated in markets, where we're going to see a 25 basis point cut or a 50 point cut. At the end of the day, perhaps through proxies in the media, the Fed sort of signaled that we were likely to see 50 points. There were a lot of news articles from influential journalists that came out over the weekend, and market pricing adjusted to a 50 basis point cut. The real question, from there is whether or not that 50 basis point cut signals the Fed's confidence that it needs to revert to a more neutral setting in terms of interest rates, or whether indeed the Fed is concerned about the US economic outlook. And so, is this 50 basis point cut one of trying to get back down to target with a relatively high degree of confidence the US market can withstand this and that inflation is coming down, or indeed are they worried about the US economy? And overwhelmingly over the last 2 days, what market pricing has done is really reacted in the sense that the Fed is confident as to the path down in terms of inflation, and across various markets we've seen pretty strong performance. Now I just show here on screen that the dot plot, and this indicates from Fed governors, the expectations for where the Fed funds rate will be at the end of 24 and the end of 25. And so essentially what the Fed's telling you is that we've had this 50 basis point cut. We expect in the median to see 2 more cuts of 25 basis points this year. That's, if we look at Chair Powell's commentary along with the dot plot, it's unlikely they'll continue to cut by 50 basis points. More of a slower cadence of maybe 25 basis points cuts. Market pricing, so the green line shown there shows the median expected Fed funds rate at the end of 24, 25 and out into the future from those governors, and then we see what market pricing is in the white line there. So market pricing for a greater level of cuts, but we sort of tend to see this tussle between Fed expectations and markets all the time. Look, the good news from a market standpoint is that these cuts are now underway, and while on the day there was a bit of back and forth in terms of price movements, the market overnight has reacted quite positively, just after digesting these changes.
Not bad if you bought bonds 6 months ago, Cam.
Not too bad. Yeah, we'll show a chart of that actually. So if we look at some of those underlying factors, there have been noise and concerns maybe about weaker job growth in the non-farm payrolls. But if we look at the unemployment rate and another representation of unemployment in the weekly jobless claims, they have remained very benign. So I think that's a vote of confidence for the US economy. But also very importantly, we know that basically goods inflation has come right down, in fact slightly negative. The services inflation is really driven by the wage story in the US, and wage price growth or wage growth is falling nicely, and so that sort of speaks to that soft landing narrative, which is playing out. I guess if we look the outlook in Australia, we have lagged the world in terms of inflation on the way up, and we're lagging on the way down. We saw unemployment and jobs numbers come out yesterday, maintaining unemployment rate of 4.2%. Very strong jobs growth, 47,000 jobs created. And so, if we look at the Australian economy, I think the RBA would, feel that they have been vindicated by, their decision to so far leave rates on hold. When everyone else really across the developed market world is cutting rates, they've left rates on hold. They still see that the labour market in Australia is running very strongly. We've got a very high participation rate as well as very high level of jobs creation. And so for the time being, they believe that they need to keep rates where they are to keep that tightness in the market until we start to see weaker jobs growth or perhaps a further tick up in unemployment and then we'll get hopefully 2 quarterly CPI prints or trim mean inflation before we get that rate cut coming through next year. So our view is that those rate cuts for Australia won't come through until next year, but we will be dragged into a cutting cycle like the rest of the market. Just briefly, and you'll have these packs, but this is a reflection of the market pricing for rate cuts. So there's a slight chance of a rate cut in Australia this year, according to markets or according to what's priced into futures markets. But our view is that that's unlikely until we see 2 more quarterly CPI prints. So that's for the Q3 and Q4. That Q4 number won't come out until January. So it's early next year that we expect that we may have the first rate cut in Australia. Turning to markets and how markets have reacted, really, we've sort of seen fears of a no landing earlier this year. We saw strong inflation and strong growth out of the US. Pivot back to that soft landing, strong equity market performance. We'll dive into the US equity market. The US dollar is in fact sort of weakening, and that's a sort of, I guess, a sign of robust global growth or a strong growth outlook based on a robust US economy. And I think Gab mentioned before that fixed rate bonds have done well. We can see like what's happened to bond yields, absolutely, getting compressed there, and that's good if you hold bonds. If yields fall, that's capital appreciation for your bonds. Interestingly, commodities have been quite weak, so we'll probably touch on that. But this is sort of the story around bonds, is that a lot of people sort of talk about, well, we've actually had all the hikes, and we're now expecting cuts. Is there any sort of juice left in the squeeze? Is it worth holding bonds? We typically see that bond yields still compress in a rate cutting cycle, so we're still in a good position there. Sorry, Gab, do you have a question?
No, sorry.
With a view that the US is cutting rates, they've had their Fed funds rate or their cash rate elevated for so long versus, for example, the Australian RBA rate. with a view that rates are going to be cut, this is likely to be a net positive for the Australian dollar. This has implications for how we invest as Australians. So that rate differential where you can earn more in the US versus Australia is starting to compress. Historically, you've had higher rates in Australia than the US, and that's been a positive for holding Australian dollars. That we actually expect to see further weakness in the US dollar based on this, if you like, a soft landing narrative playing out there. So we think that's good news for the Australian dollar. And then just turning to another asset, gold. Gold's been a really interesting asset class, or asset, if you like. It is somewhat defensive, but it also gives you, I guess, exposure to a few factors. One is in a rate cutting cycle where fixed rate bonds, if you like, or nominal bond yields are falling faster than inflation expectations. The cost of holding gold, the opportunity cost, or if you like, the lost yield from not holding a yielding asset in gold reduces, and that tends to be quite positive for gold. We also see that a weaker US dollar is very positive for gold because people will trade out of US dollar assets and seek to hold gold, and we certainly have seen some US dollar weakness overnight. So there are a few interesting asset classes and some thoughts from ourselves as to how these asset classes are likely to behave through, if you like, towards a soft landing, and particularly that US pivot there. Really briefly, I'll just touch on probably the chart to the top right here. This shows earnings expectations for the global index, which is the All Country World Index. That's a representation of all equity markets. And we see, very strong sort of earnings growth. You see if we just look to the annual years, in pink we have 2023. What is expected and what has been partly realized in 2024 has been strong earnings growth, that uplift in the sort of, I guess, I call it khaki line. And then if we look forward to 2025, again, relatively strong earnings growth priced in. And so that's supportive of risk assets. It's supportive of equities. I'll just skip forward here. We should note, though, that equities are, if you like, on the expensive side. We see center of screen the relationship between the 10-year US bond yield and forward price to earnings ratio. So in the US, the S&P 500 trading just around 20 as a price to earnings ratio. So that's slightly expensive, but if we look at the global markets, it's really the US economy driving a lot of this growth. So perhaps justified. Australia does look a little bit expensive too, particularly if we look at our growth outlook across sectors. We know that our material sectors been somewhat threatened by weaker commodity prices, although we saw iron ore skip up a little bit overnight. And so a bit of a mixed picture there in terms of whether or not you want to stay where the earnings growth strength is in the US, or whether you want to look for slightly cheaper exposures outside the US. I'll talk briefly about one factor that we've sort of been looking at, which is whether or not we're going to see a rotation. A lot of commentary about the strength of US tech in particular. A few charts here, but essentially, if we look at US equities over a very long-term period, so the top right chart there, there's been a lot of talk about US equities outperforming all other equity markets over a 10-year period. That's actually largely driven by fundamentals or earnings growth. So the black line shows you the relative earnings growth of the US equity market versus other earnings markets, other equity markets. And so what that's telling you, the black line going up, is saying that the earnings growth in the US has been stronger than outside the US, and that's justified a lot of the price move up. However, we're seeing a bit of a valuation gap here. Now, where the US equity market has been year to date has been if we look at the orange, the tan line, I'll call it, we've seen relatively strong performance from the US equities. However, a lot of that has been driven by the NASDAQ, or those tech stocks, the line in gray. Now, quite interestingly, since if we go back to the period where we started to see Chair Powell talking about a pivot, towards the start of July, we've actually seen the equal weight exposure outperform broad markets. And that's telling you that the US equity market is looking to broaden out, which is probably consistent with that sort of soft landing narrative there.
And that's probably what we'd expect when seeing a bit of deleveraging from those top stocks across the NASDAQ as well, Cam.
Yeah, that's right. I think it's healthy for markets.
Yeah.
It's good that they have such strong growth, but given valuations, good to see that the rest of the market catching up. That's a bit of a flyover in terms of the economic backdrop. I'll maybe just touch on a few things in terms of of our models, in particular, what some of the changes that we did make to our strategic asset allocation, and then talk about the DAA changes.
Yeah. And I've just seen a couple of questions come through as well. Some of them are more on the complex side. So look, we'll endeavour to get back to you via either a phone call or a quick email as well. But just in the interest of time today, we'll just keep pushing on, if that's good, Cam.
Yeah, great. So I guess one thing I just wanted to highlight. Look, we've seen quite strong performance from our managed account portfolios, particularly if you look over the last year. And one attribute to that is the use of not just broad market cap weighted indices, but looking to add value through low cost smart beta approaches. And I show here the way that we use fixed income in Australia versus, if you like, a low cost benchmark weighted fixed income exposure in the grey line there. And it's been really interesting to see how we've used these building blocks. And I think this chart really demonstrates this growing jaws, as you might call it, or the gap between the orange line, in fact, our fixed income exposure that we use and how we look to build a fixed income portfolio, versus if you like, the default broad market exposure. And it sort of talks to some of the value we add as a model manager and thinking a bit more holistically about how you want to construct a portfolio.
One of the beauties there as well, Cam, is that being able to manage those two allocations between floating and fixed means that we're not necessarily pinned to the movement of one underlying index, right?
Yeah, that's right.
In different scenarios, we can make changes based on whether we want to be more heavily focused on fixed rate bonds like we might be right now.
Yeah, that's absolutely right. And having those levers to pull is really valuable. Now, we did talk about this last time. Happy to take questions afterwards, but I'll just briefly recap on the changes that we made in July to our strategic asset allocation. We introduced a portion of our global equities as a currency hedged exposure. We think that makes sense from a strategic asset allocation decision. That's not a tactical view on the Australian dollar. It's a decision based on a long-term view as to what the right risk characteristics of a portfolio look like and the right level of currency hedging. So 30% of our global equity exposure is currency hedged now, and we think that's going to stand us in good stead over time. And frankly, from a tactical view, it has worked so far. We introduced a global equity exposure in Glyn and iShares ETF, 15 basis point, very low cost global infrastructure exposure. That's been a really good addition. And then finally, we added an Australian quality exposure. So Australian equities, quality companies. And what we've seen since the addition of that is that's actually performed quite well. It's outperformed the broad market indice, and that's added value. In fact, our QOS, which is another one of our Australian equity exposures, slightly underperformed the index over that 2-3 month period. And so having AQLT in there has certainly helped. Happy to take questions on those points later, but in case you missed our last update, they are the strategic asset allocation decisions that we've changes that we made or implemented the last time. And then briefly to our last I guess meeting and decisions from the investment committee. So I mean, to summarize some of the points I made, we believe that inflation, we've got increasing confidence that inflation is coming down. We see rate cuts, and I think there was a bit of a comment about the dot plot, which we can get to. Our view is you don't have to be absolutely precise with knowing what the number of rate cuts are. It's really more knowing about the direction of travel and understanding, roughly when we're starting to see those rate cuts that often, fixed income markets will react after the rate cut. And so that does sort of in a way, paint a picture that fixed rate bonds are still going to be a good diversifier if we have a hard landing, but they're still worth holding even in a soft landing scenario. However, we do have a view that it is worth having some increased exposure to global growth assets. The way we've implemented that is, particularly in the growth portfolios, is a slight overweight to currency hedge global equities. It's a very simple way of expressing that view. It's not an overly large allocation or overly large dynamic tilt. But if we look, for example, in the balanced portfolio, we see that overweight to growth assets in grey. That is expressed through currency hedge global equities. And that plays well to a US dollar weakness, and it plays well to growth spurred on by a strong US economy. And then finally, we've actually reintroduced gold into the portfolio. Gold worked very well for us last time.
It's been some time, 3 years, I believe.
It's been a while,
Yep.
but yeah. So gold has performed quite strongly, but we do also see gold as really, it's a bit of a, in a way, a high beta play to a rate cutting cycle in the US. And so gold has performed well since introduction. We think that can add value, and particularly in those portfolios where we've got more defensive assets, like the conservative portfolio, we've added more gold. Whereas in our if you like, more growth oriented portfolios, it's more of a focus on that currency hedge global equity position. In really small font, we can show these changes. I'm sure you'll get these slides afterwards, but I'll just show them briefly there. So you might have an opportunity to ask questions, but looking across towards the line that says international equities, you'll see in the change columns, that increase in global currency hedged global equities, increasing from 1.5 up to 4%. And then in the gold line, which is the bottom of the defensive section, you can see the allocations to gold there. They're relatively minor allocations overall. I don't think that we sort of swing for the fences. It's about making incremental tweaks to sort of express our view and our overall overarching increasing level of confidence in a soft landing, but also retaining bonds for also there's that alternative case of a hard landing. You still want to make sure
Absolutely.
You've got something performs if you don't pick the market cycle correctly.
We might even just take an opportunity to answer a question that's come through from Jack. Thanks, Jack, for sending a message through. Given you've gone overweight currency hedging global equities and currency hedge gold, does that mean that you're quite bullish on the Aussie dollar?
In short, look, yes. I'd sort of maybe qualify that by saying relatively bullish on the Australian dollar. I think currencies are notoriously hard to pick, but I think from the position of gold, there's two key factors. The cutting cycle, I think, is net positive, and also the potential weakness in the US dollar is net positive. We also think that geopolitical risk, gold is a great asset to hold for that reason. We've got some notes out on gold which you can read. And yes, in terms of a expression of a strong US economy driving the global economy, we think that currency hedged global equity exposure is consistent with that view.
And I mean, even in the most simple terms, you've got the fact that there's probably a little bit more uncertainty around what's going on in currency markets. And for us, running a relatively long-term and simplistic portfolio, we're aiming to ultimately minimize tracking difference over time, or tracking error rather. And so that means that we're just trying to smooth out returns. So it's not a full hedge across our international equity or gold exposures, rather just a modest hedge to eliminate some of that tracking error.
Mm-hmm. Great.
Cool. If we keep jumping on, I think we're getting close to the end, which is sad here, Cam. But just to wrap things up, most of you who are already implementing the managed accounts would be aware of the collateral that we release on a periodic basis, revolving around SMA product profiles. We also have our monthly fact sheets that are released, and our quarterly reports that we're forever working on as well, which I have detailed in the next slide. One thing that I would mention that has become increasingly popular alongside the use of our SMAs is the white labeling opportunities that revolve around our quarterly reports. So we have multiple advice groups that are working with us that do like to have their own marketing collateral put out to their client base. If you'd like to white label your managed account quarterly report, please get in touch with any one of the before mentioned names, and we'd be happy to try and liaise with you to get that done. Additionally, we also have an increased demand for our business acceleration services. Ultimately, we've designed a suite of business that is tacked on alongside your own business to help you put together, ultimately, things like your client value proposition, your investment philosophy, fee statements as well. There's a lot of things that we'd like to put together to support our managed account users, and frequently these are being taken up by our clients as they leverage our services. I'll finish off just with a couple of quick and easy questions that have come through. So thanks for passing these ones through. I've got Michael here. What is the platform availability like for these SMAs? As I've said in managed account updates before, we are one of the most deep in terms of allocation across multiple platforms. I think we're across basically all of the wrap platforms now, Cam, and their consolidated menus as well, being the baby wraps or core menus. And then finally, if there's time, would you mind covering how you've constructed the Australian equity sleeve of the portfolio as well? I mean, we can just jump back a couple of slides and answer that question for you.
I tell you what, this is a great question. I actually included some slides from our last quarterly update, so I'll jump forward if you like. I wasn't sure whether this would come up, but
very prepared, Cam.
Well, you never know. As I mentioned in our strategic asset allocation changes that we made earlier this year, one of the introductions was quality within Australian equities, and so the way that we've sought to do that really is to blend AQLT, which is our Australian equities quality exposure. It's a great ETF, performed very well, together with QOS, which is a somewhat dynamic tilt to value. QOS is a fundamentally weighted index. The benefits of using these two building blocks is they both have generated outperformance over time. But what we see on the chart on the right-hand side is their excess returns versus market over a 1-year rolling basis, and it tells you when these two funds are indeed outperforming and underperforming. And you can see there's nearly a mirror image there. They have negative correlation, and so the approach, if I can just move forward, is really one of reducing tracking error, but creating strong outperformance. Overall, the blend results in lower drawdowns than either of the two individual building blocks and a higher overall performance. I show the chart here of AQLT and of QOS in red and blue versus grey being the broad market. In green, if you can see that in the chart, that's actually the blend of those two funds in the weights that we hold, which is roughly 2/3, 1/3. We find this produces a lower tracking error with really strong performance. And indeed, as I mentioned before, since adding AQLT, it has helped portfolio performance. So that's encouraging to see. So it's really about using some low cost A200, 4 basis points, you can't get any cheaper, with two complementary factor style exposures, which we believe add performance in the long term, but in combination, really control for risk.
And it's great. Like I think we've seen, increased uptick in interest in those funds outside of the managed accounts as well. There's been a lot of utilisation around our Australian Quality Fund, which is great to be able to express in our managed accounts too.
Yeah, absolutely.
All right. Well, if there's no further questions, we'll let everyone get back to their Friday. Really appreciate everyone tuning in, and we'll see you next quarter.
Thank you.